When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Thank you so much. Welcome to Retire Your Way with Dave Lopez. My name's Jeff Shade, and I'm just here to ask the questions for you, but the words of wisdom and solid advice come from the managing member and owner of ILG Financial. That would be Dave Lopez. How you doing today, Dave?
I am doing great. It's sure good to be with you again, Jeff. I sure enjoy. Sometimes I forget that we're having this podcast as a talk with all of our listeners and not just you and me. And I tell you, I just enjoy the time we spend together pontificating on the world events.
Yeah, that's right. Likewise, too, Dave. Always enjoy your company because you've always got such a great insight into things, and you have the ability to maybe sometimes take very complex topics and break them down so that everyone can really understand them. And, you know, what's going on right now is not a simple thing with the coronavirus and especially its effect on the economy. I think, though, America really has a case of cabin fever, so much so that when the door cracks open a little bit, I mean, people don't just stick a toe out there. They come barging through the door. And beaches, when they have a chance, they get out and just go hog wild. They're shoulder to shoulder. And really, I think that this may present a problem in the future. What do you make of all this? Is America tired of being pent up and tired of not working? And the thing that occurred to me is that at some point in time, we're going to have to pay the piper for this stuff.
We are, and you hit it on the head. It is cabin fever, and the easy answer to that is, if someone would ask me that question, is the country experiencing cabin fever? The answer is, are you? And I don't know anybody who doesn't say, yes, I am. But I think what you're seeing here with these almost like revolts where people are flooding bars and public events and partying like it's 1999. Remember that song?
Oh, yeah. Oh, yeah.
I think what you're seeing is you're starting to see an erosion of the trust of the media pundits and the narrative that's out there, right? Because you've seen the story change of the risk from a mortality rate of up to 4% to now maybe 1/4%. And even that mortality rate is focused primarily on folks with already compromised immune systems, which can mean in some of the statistics that, you know, if you're under 50 and you're healthy and your immune system is strong, you have mathematically almost a 0% chance of dying from the coronavirus. So what you're not seeing, which is interesting, is you're not seeing 55 and up folks partying like it's 1999. What you're seeing is this younger generation saying, look, I'm being told to stay inside, I'm losing a paycheck, I'm not able to congregate to stop this spread, but it's not affecting us. And that could be a problem down the road.
Yeah, Dave, you talked about the paycheck there, too. And I think one of the reasons that people are not maybe stressing as much as they would is because, you know, right now, if they filed for unemployment, they're not only getting the unemployment for their state, but they're also getting that extra $600 federal bonus. However, that bonus of $600 is going to end at the end of July.
Well, and that's why one of the things we talked about in several podcasts, and even off air, Jeff, you and I have talked about, what is this seeming disconnect between the rising stock market and these economic events that by any other measure are devastating? And I would argue that it's because as long as people are still getting paid, whether it's an unemployment check or a stimulus check, you name it, right? Then things seem like they're going on as normal. And one of the examples I gave is that when we talked about when you were a kid and your dad gave you an allowance, you were able to put gas in the car and you were able to go to the movies with your friends, and that's the lifestyle you were used to. And none of that changed until Dad stops giving you an allowance. And that's when your life changes. And it changes on a dime, doesn't it? All of a sudden you say no to your friends, I can't go to the movies, and I can't drive you because I'm out of gas. And then life gets difficult, right? You've got to find another income stream. Well, that's what's going on here, right? We've had basically an 8-week snow day with people getting, in many cases, paid more money to sit at home than they were earning, and they couldn't spend it. right? So of course they want the chance to go out and spend it, especially if they now believe that they have very little risk of serious illness from the coronavirus if you're younger. But those $600 a week, by the way, extra bonus to unemployment, I think that ends in July. So you're going to start to see things get ugly, in my opinion, very quick as people can't make rent payments, right? They've probably made April and maybe May just with the unemployment checks and the stimulus checks. But once the free money printing stops, then you're going to see defaults on rents, which could end to defaults on mortgages, right? With unemployment, you're going to see more people clamoring in a dissatisfied manner for free food. And then you're going to start to see, I would guess, the stock market start to follow suit with the true economic realities of what's happening here.
Yeah, I think the market has experienced some false bounces up and down. And you talked about dad giving you money. In this case, it's uncle giving us money. It happens to be our Uncle Sam, and Uncle Sam just prints it down in the basement, and it is good money. But I would imagine that there is a limit to how much and how long that Uncle Sam can print that money before, the authorities come knocking at the door there. So what happens when the authorities come knocking at the door? I mean, what happens when Uncle Sam just says, hey, I'm out of ink, I'm out of paper, I can't print any more money?
Well, it's a lot like a traditional Ponzi scheme, isn't it? Right? Which as long as the Ponzi scheme's running, everything looks fantastic. But when it crumbles very quickly. And you've seen evidences of this in other economies, like Argentina when its currency was devalued, or even think back to Berlin when the Great Wall crashed. Right up until it crashed, the appearance was that everything was fine, with the socialist governments there, and then in an instant it falls apart. So that's how Ponzi schemes implode. They build and build and build, and when they implode very quickly. So the big unknown is how long can we print money with no regard for the debt we're running up before it starts to implode. Now, the bigger the Ponzi scheme, the longer it can last, right? This, I would argue, is the biggest Ponzi scheme in American history. So it may last 10 more years, right, before it implodes. It may last 10 months before it implodes. The challenge here, and this is what we talk about with our clients, is the one thing we're sure of is when you listen to all the quote-unquote experts, and you can include me in that if you'd like, is nobody knows. Nobody knows for sure. We are in complete uncharted territory. There's no data to fall back on when a government is printing money like this. In fact, the Fed went further this time. When they said we're printing money, they said we're all in, which was code for saying we're not going to ever stop printing money until this thing gets fixed. And that's why I believe the market has gone up. When you get a backstop of Uncle Sam saying, don't worry about the stock market or the bond market. If we have to, we'll write checks to everybody. No bad consequences for taking risk in the market. Well, sooner or later, they have to stop that. And it may be them voluntarily stopping it, or it may be all of a sudden foreign entities and other folks just not buying government bonds because they now think they're worthless. They're never going to get paid back for them. But sooner or later, you cannot print money with no backing forever, and it will implode. So our goal when we work with folks in or near retirement is we need to protect you if it happens early. What if it happens in the next 2 to 3 years? If it happens 30 years from now, you're probably going to be fine, but nobody knows when this is going to happen. And I haven't met anyone ever or read any documentation from anyone who believes that a country without any restrictions just print and print and print money and have no economic consequences. I've never heard it. So it's a scary time. The good news is there are steps we can take, right? A lot of folks say, is there any good news? There absolutely is. If this is a view you share, there are steps you can take to not only protect yourself from this type of event, but prosper. A lot of people forget that a lot of millionaires created generations of wealth that was passed on from one event, and that was the Great Depression. And the reason is they saw what was coming and took precautions to position their assets to prosper from the economic downturn. And that's not saying you're going to prosper at someone else's expense. It's just you acknowledging that a wave's coming and not taking the wave head on. And we can show people how to do that, Jeff.
That's right, Dave, and people listening to this podcast certainly know that you have a lot of, tools in your arsenal there at ILG Financial to help people get through this, also get to and through retirement. And I want to remind folks that as you're listening to this, too, if you like what you hear from Dave and our program, you can always contact Dave there at ILG Financial. Get a complimentary, no-cost, no-obligation financial plan. That's right. Right now is your opportunity to call Dave or one of the people there at ILG Financial. Ask the questions that you've always wanted to ask without being pressured pressured into anything. As I said, it is free, no cost, no obligation whatsoever. To get your plan, call 540-720-5656, 540-720-5656. Also, check out the website. I think you'll find a lot of great information on that site. It's ilgfinancial.com, ilgfinancial.com. Dave, we've been talking about the 5 economic cracks in America's foundation, and this is part 3 of our series. And during this coronavirus epidemic, there's been a lot of effort being put into making everything look like it's still great, and it's going to be great in the future. But I think what people really aren't talking about are the massive economic cracks that may be forming beneath the surface.
Yeah, that's true. And as we just spoke about, which is interesting, is that these economic cracks that this series is on, and I'm glad we get the chance now to do it in the middle of this coronavirus, none of these are the result of the coronavirus. The coronavirus is just an additional negative factor that's going to be hitting our economy. It's going to actually be exacerbating the challenges of these 5 economic cracks. So it's kind of like a magician where he gets you to look at one hand and not the other. We're so focused on the medical issues with the coronavirus that we're not looking at these economic cracks that were here all along, but they're now just getting worse with the pressure, the negative pressure of the economic downturn as a result of this virus.
Dave, over the last couple of weeks, we looked at the first economic crack, the potential for another stock market correction. And here in today's show of the series, we're going to be discussing the $30 trillion wealth transfer. So we want to make sure that people not only listen to this show, but if you didn't hear the past show, you can go back and listen to that and stay with us for the next show. So, Dave, let's talk about this. After World War II, there was a massive increase in babies being born. U.S. births increased at an unprecedented rate for the next 18 years. And this group of 75 million Americans has come to be known as the baby boomers, and they're the most powerful demographic force in U.S. history, and they control over $30 trillion. That is 70% of America's economic activity.
Yeah, that is right. And what's interesting about this group is that in 2007, this group of, 75 million Americans started to retire. A total of 75 million baby boomers. We've got over 50 million still exiting the workforce to the tune of 10,000, get this, Jeff, 10,000 baby boomers a day are now retiring and will probably continue to retire here over the next 10 years plus. So really the question is, what does that mean to us individually with our individual economies? What does it mean to the macro economy? And what does it mean to our retirement? I would propose that look at this at an individual level if you are in or near retirement, because what's happening to you is what's happening to these other 75 million Americans. It means, one, you'll no longer be working. As a result, you're no longer going to be investing in your 401k or IRA. So that's money that was going into the stock market that is no longer going into the market. Multiply that, Jeff, by 75 million people. Also, you've been, for the last 20 or 30 years, because of your guaranteed income stream that you've had from your job, spending and paying for college for the kids and buying them cars if you're like me, right? And then fixing their mistakes and then funding their sports. Spending. Now I need a new couch, right? Now we're going to upsize to the next size house. Oops, now we need another car. Upsizing and spending because we were comfortable with our income streams. Now the kids are gone. The sports have stopped. We're not buying the new cars. We're really not upgrading. We've got the washing machine and the sofas. We don't need new stuff. So our spending dramatically reduces. And this slowdown as a result of the 75 million baby boomers reducing their spending and not only not putting money into the stock market, but because they've saved this money for income and retirement and they're now in retirement, Jeff, these folks are going to start withdrawing from the stock market. So can imagine a group of 75 million people now withdrawing systematically month after month, every month from the stock market. Now, that's, by the way, exactly what happened in the 90s. In the 90s, we saw one of the biggest stock market expansions in U.S. history. And I would propose to you that what went on in the 90s is exactly what's about to happen here with this, what we call this demographic cliff. It was just in reverse. And what I mean by that, in the 90s, you had the mass of baby boomers, this group of 75 million people hitting what we call their peak earning years. And what I mean by that is they were earning more per hour than they'd ever been earning in their life. They had more disposable income, and with retirement right on the horizon, they were saving more in their 401ks and IRAs than ever. So you multiply 75 million people flooding money into their IRAs and their 401ks in the stock market, the market's going to go up. It's kind of like having a small pond and all these other economic events. Republican president, Democrat president, Republican House, you get the idea. Those are little pebbles being thrown in the economic pond that create little ripples, right? That affect the economy and affect the growth of the market. Well, this demographic cliff, this group of 75 million people in the 90s, all flooding money into their IRAs, is like a little kid picking up a boulder in the midst of these pebbles and throwing a boulder into the pond. And the waves it creates literally wipe away any of the small ripples from the pebbles of these other economic shifts. It's just that big of an event, Jeff.
Dave, I love the analogies that you make there because I can just picture this, and it really does make a lot of sense when you put it that way. What does all this mean? What is the takeaway for this in terms of the economy moving forward? And I'm talking about the market, possible deflation, and of course, I think higher taxes certainly just around the corner.
Right. So the end result, and we've had this common theme in the past, right? And no one likes to hear this, but we kind of lay it out on the table as it is, don't we, Jeff? Absolutely. And what I'm saying here is you've got to make a bet. Right? You have got to make a bet on where you think the economy's going, taxes are going. I can give you data to help you make that decision. I can give you recommendations or how I'm betting, but ultimately how you invest, how you spend your money, how you protect or fail to protect your money from future taxes is all going to be based on your bet on what's going to happen in the future. One position is, and the one we're talking about here is, if you look at this group of 75 million people moving into retirement, not contributing to their 401ks or IRAs anymore for the first time in 40 years, that alone would slow the stock market down for a considerable amount of time. Just the volume of people that have now stopped participating in investing. Now add to that this 75 million people are actually going to be withdrawing for the first time in their lives from their IRAs and 401ks. Now you have an exodus out of the stock market that has nothing to do with fear and greed. It's just the normal economic cycle of this huge demographic moving into the distribution phase of their life. Well, I would suggest that if that group is so big, and you add the fact that the group behind them, the millennials behind them, are saving less than ever because of the burdens on them, like student loan debts and things like that, that you are going to have a huge chance of a huge economic slowdown over the next 10 or 15 or 20 years until this demographic group starts to die off. Now, if that's the case, you do not want to be planning on the market going on another 11 or 12-year tear over the next 10 or 20 years. And then that would allow you to make some decisions to protect your retirement income, regardless of whether the market goes up or it goes down.
Dave, you talk about making bets there, and I know at ILG Financial, and really any, I think, qualified financial planner does not make plans based on bets. I mean, without getting all the information. How do you handle all this information that you've just talked about? And we know that things are going to be different in the future. What information do you gather together to make sure that someone's retirement is actually not a bet, but more of a sure thing?
Boy, thanks for saying that, because you're right. Our whole mission with our clients is to make sure that we are not betting, for lack of a better word, on one specific economic outcome. And if we're right, you've got a fantastic retirement and you leave your kids a lot of money. And if we're wrong, you run out of money and you're living off a Social Security check. That is exactly what you don't want for your retirement planning. We do just the opposite. When we build out our plans, we build them out assuming we're not sure how this is going to go. So we want to build out a plan where you're going to receive the money you need for income in retirement, the money you need for your trips, for your vacation, for your health care, all of your needs. We try to build out a plan that's going to guarantee that income for you, whether the stock market goes through the roof over the next 15 years, or whether, like the Japanese index, the Nikkei, it goes down 70 or 80% and stays down there for 20 years. We don't know which one's going to happen or where in between we're going to fall. So we actually stress test every single retirement plan we build to decide how it's going to perform, or our best guess as to how it's going to perform if the markets go through the roof, how it's going to perform if the markets tank and stay low, how it's going to perform if we have dramatic inflation, how it's going to perform if we have deflation, and so on and so forth. I would suggest, whether you're building something, whether you're building a retirement plan, a shed in the backyard, a car, you want to use that same type of a stress test model to build a plan to give you the best chance of success. That's what we do when we build our plans, and I recommend that for each and every person listening today.
Well, Dave, I'm sure that most people listening to us today do not want their retirements to be a bet, but more of a sure thing. And I know that you offer a no-cost, no-obligation financial plan there at ILG Financial. So, Dave, how can people listening to this podcast today take advantage of the opportunity for this plan?
Well, it's never been easier. You can go right to our website. That's, as you mentioned, Jeff, ilgfinancial.com. And there's a red banner actually at the bottom of the website that says schedule your virtual meeting. All you need to really put in there is your name and your email address and your number, and we will get right back to you and schedule a 15-minute call. There's no charge, no obligation. And the goal of that is just to get your questions answered. See where you are, if there's something you heard today that you want to talk about. And then from there, we can discuss if you want to build a plan out. And if you do, we'll do that free of charge as well. So give us a call and we can talk about that.
And once again, Dave's talking about that footer at the bottom of the website. It is in red. If you prefer to call, you can do that as well, too. 540-720-5656 if you just got a couple of questions you want answered. 540-720-5656. We've been talking about cracks in America's economic foundation with Dave Lopez. And I want to thank all of you for listening to us today. If you didn't hear the previous shows, they are available right here on the website. And we want you to join us again next week as we continue our series with Dave Lopez of ILG Financial. Thanks for listening to Retire Your Way. We'll talk to you again next week.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of Alpha Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Alpha and ILG Financial, LLC are independent entities.